Hello everyone, KT from Atocha Global Analytics here. Today we start with the questionable truth of the day from the SHET files. We premiere a new segment called Everything is Fine, because we know everything is always fine. And lastly, the next crisis. What is it? Where is it coming from? All that and more. Atocha Global Analytics. Please like and subscribe. Hello, KT again. Just wanted to let you know that Atocha Global Analytics was created to provide foresight and insight into macroeconomics, real estate and finance trends, and the policies that shape them. And today's video is all about how policies have shaped not only our economics for the last 50 years, but how they're shaping them in the foreseeable future. As usual, wanted to start out with the questionable truth of the day from the SHET files. SHET meaning somebody heaving excrement today. So today's questionable truth of the day comes from an article I found in Fortune magazine. And of course, the central banks, specifically the Federal Reserve, have been stating that inflation continues to be a problem because of demand. And obviously, that's a very questionable truth. And today's article directly refutes this. Okay, well, this article was written by Richard Werner, and I took the article and wanted to print it out. It's 10 pages of text plus graphic inserts and various things. So it's a rather long article, so I won't cover much of it, but I want to give you some of the high points. This gentleman was heavily involved in not only the creation of quantitative easing as a concept, but also wrote some significant papers that ended up being the foundation for what was applied in Japan's economy back in the 90s. Now, anyone who's familiar with the Japanese economy knows that it did not fare very well in the 90s. They called it the lost decade. There were some real systemic problems there. So why does what I lead with that? Well, this gentleman wrote a paper that had a very comprehensive plan, and what the Japanese central bank used was just one part of it. And unfortunately, it was not something as a broader system that would work when you took certain components. I want to make that note because he addresses issues later on regarding the 2008 financial crisis and the Federal Reserve's response, as well as more recent events. So the name of the title of the article is "The Expert Who Pioneered Quantitative Easing Has Seen Enough. Central banks are too powerful and they're to blame for inflation." Most of you, if you've seen any of my videos, you know I'm rather critical of the Federal Reserve and how their policies have impacted different markets like the real estate market. But it is also how it interacts in conjunction with fiscal policy. And many experts believe that fiscal policy alone doesn't really create any kind of expansion in the economy, depending on the policies, obviously. But that it is a combination of fiscal policy and monetary policy that is required to have a genuinely growing, thriving economy. And I agree wholeheartedly with that. One of my common criticisms is that we have been relying on monetary policy to create too much growth or too many incentives for growth and not enough fiscal policy incentives since the late 80s or early 90s. And that has resulted in some of the tepid growth that we've experienced in the last 20 years or so. So regarding this particular article, the gentleman starts out with addressing something that I addressed in just a couple videos ago, which was that one of the core catalysts in the inflation and recessions in the past, but specifically in 1973, the oil embargo by OPEC that was in response to the war between Israel and the Arab countries at that time. That spike in oil prices was not only inflationary, but it was also crippling to the economy and slowed growth significantly, leading to recessions and other impacts. And that we have seen a pattern of this where sharp rises in oil prices because energy impacts everything throughout the economy. These sharp increases, though usually somewhat temporary, they have precipitated resulting declines anywhere from a few months to a year or two later. And this individual, Richard Werner, and The Conversation are credited with this article that was released yesterday afternoon. He starts out noting that, 50 years ago, the oil spike was credited with inciting some of the inflationary problems, and immediately refutes that there had been signs of inflation beforehand. And I don't want to discuss other things that were factors. Obviously we had some significant policy changes coming off the gold standard, Bretton Woods. These issues dramatically impacted the economy. Those are weeds issues. They would get us lost. But the point is we had tremendous inflation. We also had tight price controls in the 60s that were then rescinded, allowing the market to correct. So there were distortions in the market, both in a restrictive sense, and then of course you had impacts from oil, energy, and changes in money supply, even back into the currency. All these things coalesced to a pretty toxic soup in the 70s. So their issue then and our issues now are somewhat different in many of those regards. But he wanted to address various things, and this is a portion I felt was important to read. With the exception of the Great Depression in the 1930s, the great inflation of the 70s was generally viewed as the most dramatic failure of macroeconomic policy in the United States since the founding of the Federal Reserve. Judging from the dismal outcomes of the decade, especially the rising and volatile rates of inflation and unemployment, it is hard to deny that policy was in some way flawed. And that is very obvious to even the casual observer. He goes on, obviously it's a very comprehensive article and it's incredibly detailed, and not to get too bogged down, but he applies it to now. Actually, the Federal Reserve in 2008 had used a portion of his paper as well, but it was a portion of the overall plan that was not intended to create an expanded money supply. And where the money supply comes from in past years or in past eras of recent history, about 3% of our money supply was directly created by the central banks or governments, leaving 97%. 97% of all the money created was through retail banks. It was through various forms of lending. So his belief, his assertion is that because his policies had been used, or parts of his policy concepts had been used during the financial crisis during 2008 and the rest of the Great Recession, specifically aspects of quantitative easing, that because it did not cause inflation then applying it now would not cause inflation. And so that brings us up to kind of a current situation. Here it is. He had a couple myths he wanted to bust right off. He said myth number one to bust was it's not the war. It is not the Russian war. Though there are, just like the oil embargo of the 1970s may have been a factor or a catalyst in creating some short-term increases or nominal increases in costs, the war in Russia is not enough to create the inflation that we've been seeing, and he does support why that is later in his article. Secondly, where the money really comes from, which is actually what I just described. The bulk of the money is actually created by retail banking. It is smaller loans, it is large loans, but it is loans taking in money and then loaning out on that. Our reserve requirements are currently suspended as a COVID measure, but the typical reserve requirements, 10% of deposits. So basically, if you take in $10, you can loan $100. And so you have to maintain that reserve requirement, but it allows banks to provide loans, and that therefore expands the money supply. So in regard to the 2008 financial crisis, I wanted to read his comment here. So, the Fed's use of QE to bring the U.S. economy back to life was regarded as a relative success. Instead, the global media reserved most of its criticism on the damage done to economies by greedy retail banks. This meant that quietly, following the global financial disaster, the central banks were able to further increase their powers again in the name of greater scrutiny of the financial sector. The European Central Bank was particularly successful in expanding its powers over the following decade. And just based on that statement, it infers he is quite critical of expanded power to the central bank. So this was the core of what I wanted to cover right here. The real cause of our current inflationary crisis. In May 2020, the gentleman conducted a monthly analysis of the quantity of credit creation across 40 countries. So it wasn't just U.S.-centric. This was most of the dominant economies in the world. He was startled to find that something extraordinary had been happening since March of that year, which everyone should know that was the start of COVID. The major central banks across the globe were boosting the money supply dramatically through a coordinated program of QE. This was a different form of quantitative easing than had been used by the U.S. Federal Reserve in 2008. Continuing, this was the version of QE that I had recommended as the second policy step in Japan in the 1990s. Which was what they had only done in the 1990s that had led to the lost decade and the massive inflation in Japan. Namely, and again continuing, namely for the central bank to purchase assets from outside the banking sector, as these payments forced retail banks to create new credit in a massive burst of money supply not previously seen in the post-war era. Firms and non-bank financial institutions that had sold to the Fed gained new purchasing power as a result. Even the Bank of Japan, having previously argued for 2 decades that it could not possibly purchase assets from anyone other than banks, suddenly engaged in this unusual operation at the same time as other central banks and on a massive scale. So, in other words, what Japan had done, realized it failed, and decided they could never do again, they started doing aggressively in conjunction with all the other central banks, or at least the dominant central banks. Continuing, he says, this is precisely what was implemented in March 2020. We know this both from available data and because the Fed, largely without precedent, hired a private sector firm to help it buy assets, none other than BlackRock. This is the same BlackRock, as I've noted in some recent videos, that has not been able to or has suspended withdrawals from their real estate investment trust funds because they were basically suffering from a bank run on their REITs. Real estate investment trusts are something I'm very familiar with. A large part of my career has been in real estate analysis and real estate acquisition. I have financially modeled approximately $200 billion in real estate assets in the last decade plus. And that's really primarily between multifamily assets and office properties, though I haven't been involved in the acquisition of offices since the pandemic, or haven't modeled office assets since the start of the pandemic. So in my experience, I have dealt with a lot of firms that are affiliated with BlackRock. And most of the investors that I've worked with, they were small to medium-sized investors that were investing in multifamily assets that were under $50 million per asset, and they were typically pooling investment funds in aggregate for $20 million in equity. And as of the start of the pandemic, there was a significant drop in these small to modest or modest-sized investors. Let's just call them modest-sized investors. They were large enough that they could invest in institutional properties when they were pooling their resources, and the firms that I've been affiliated with specialized in feeding basically smaller multi-family REITs. And so in noting that BlackRock had ceased allowing withdrawals from their REIT, clearly this is an indication that they were concerned about the having to sell assets when the market was transitioning. Since the start of COVID, virtually all investment in that particular segment, that modest investor, has dried up. For multifamily, one of the reasons is multifamily, though it has performed exceptionally well, they know that cap rates are about to increase significantly, so values are going to drop. They also know that there is a tremendous supply in the pipeline. Whether it's permitted or under construction, we are at a 50-year high, and the absolute avalanche of multifamily units coming on the market is a disruptor that will probably take several years to shake out. And that actually is in addition to, or not in consideration of, the fact that there are macroeconomic stresses and the financial sector is under tremendous stress, causing other issues with the availability of financing. If you'll indulge me, I have 3 short paragraphs to read that really encapsulate what this gentleman is addressing. So he says here, having cried wolf about inflationary risk of introducing QE in 2008 and following more than a decade of resolutely low global inflation, many banking and economic experts through the Feds and other central banks' similarly aggressive credit creation policy in 2020 would not be inflationary again. So again, the beliefs were by those that have their hands on the levers of power in the central banking world, they believed, oh, this isn't going to be inflationary because it wasn't last time. However, this time the economic conditions were very different. There had been no recent slump in the supply of money via retail bank loans because when we went into COVID, the banking system was working normally, whereas during the 2008 financial crisis, relatively similar to what we're starting to see right now, in 2008 there had been a tremendous reduction in the number of loans. He continues, also, the policy differed in a crucial aspect. By going direct, the Fed was itself now massively expanding credit creation, the money supply, and new spending, rather than using retail banks. As a result, the money supply ballooned by record amounts. The U.S.'s broad money supply metric, M3, increased by 19.1% in 2020, the highest annual rise on record. In the Eurozone, the money supply, which they call M1, grew by 15.6% in December 2020, or by December 2020. Lastly, all of this boosted demand, while at the same time the supply of goods and services were limited by pandemic restrictions that immobilized people and shut down many small firms and affecting some supply chains. It was a perfect recipe for inflation. And significant consumer price inflation duly followed around 18 months later in late 2021 and 2022. So he obviously laid out a very good overview of how he saw the impact. He saw it before it even started to have any impact during March through May and knew exactly what the impact would be, and it later arrived. So it is not just the quantity of what is done, but it is also how it is done. The Fed removed the intermediaries, removed the normal pipeline to get the money out, and in this case, ended up injecting it directly. Though quicker, it is also highly inflationary. the gentleman continues to talk about something that is on the radar. And here at Atocha Global, we recognize that certain trends are easily foreseeable. The indicators are there, but you have to invest the time to extract from data that is often overlooked to know what is coming. So this gentleman, who has a strong track record of doing just that, brings up digital currencies that central banks have been considering or pursuing in many regards for a number of years. I believe Britain put out a white paper. They're attempting to implement it within just a few years, a digital currency. And the point that this gentleman rightly addressed is, look, we've had digital currency for decades. All of our money transactions are happening digitally. However, the money creation, every aspect of these the current currencies is decentralized. It is not controlled by a single entity, whereas these digital currencies would be centralizing control and removing many of the things that happen for specifically smaller businesses and making it much more challenging for them. Okay, so here's how he addresses this. He says, unlike the unregulated cryptocurrencies, CBDCs, which are central bank digital currencies, would come with the full backing and authority of the central banks, unlike the full backing of the United States government or the Treasury in our current case. He continues a couple of paragraphs down. He says, our empirical study of the U.S. banking sector showed that big banks don't want to lend to small firms. However, most employment in the economy is with SMEs, again, small firms, which our study suggests will only thrive if we have a decentralized banking system with many small local banks. He gives an example from Europe. He says, in Germany, these local community banks have survived for more than 200 years because they use the cooperative voting system of one shareholder, one vote. That system of economic democracy prevents takeovers and hence explains why the German SMEs are by far the most successful in the world, contributing significantly to exports in Germany's high productivity. And for those of you that don't follow the European Union, Germany is by and large the strongest economy in Europe and has been since essentially the formation of the EU. So this gentleman is a harsh critic of central bank policy, of recent central bank policy specifically, and he lays the blame for increased costs directly on them. So the questionable truth of the day, inflation is not due to demand, it is due to central bank policy, according to that article. And in addition to that, what an amazing news day this has been. Not just what's going on in First Republic, of course, it continues to fall. Credit Suisse was, of course, they worked a deal to ensure the bank survives. However, there are some other aspects. I went back in time and I found an article that I remembered from my pre-graduate school days. It's from 2014. And it was from Perianne Boring, and she is a writer that really has some interesting pedigree. She also is the founder and president of the Chamber of Digital Commerce, and so she has been active in this space for many years. So I found this article dated February 3rd, 2014. It says, if you want to know the real rate of inflation, don't bother with the CPI. And she lays out some very specific things about CPI. In a recent video, I'd noted, of course, that GDP is a questionable truth of the day because of the cost of living, and there is real GDP which reflects the growth when factored for the impact of inflation. And so just as that was a questionable truth, the CPI in itself is a questionable truth, and she lays out several reasons why. But she also notes this: why does government want low inflation numbers? So it is in the government's interest, is what she is saying, that we have low inflation numbers. And here's what she said, which is exactly what I noted, and I may have gotten it from her originally when I quoted it in an earlier video. She said the CPI is tied to the incomes of about 80 million Americans, specifically Social Security beneficiaries, food stamp recipients, military and federal civil service retirees and survivors, and children on school lunch programs. The higher the CPI, the more money the government needs to spend on these income payments to keep pace with the cost of living. So when this article was published in February 2014, we then had a $17 trillion debt versus the current 31 and change. So other things that she notes here: the government has a few resources at its disposal to manipulate the CPI. First, the BLS operates under a veil of secrecy. Lack of accountability always empowers those to do things when they won't be scrutinized. But she continues, the raw data used to calculate the CPI is not available to the public. When I asked why, I was told so companies can't compare prices, which she rightly points out is not just a questionable truth, more than a questionable truth. It is a fallacy, because all that data is readily available through any kind of source out there. All you have to do is an internet search, and you can find out what prices are from your competition. So that's not a factor. Also, again, this is from 2014. Over a course of 30 years, the government has changed the way it calculates inflation more than 20 times. That was in that time window. There's other information that I recently found that they've had 8 major revisions plus many minor adjustments going back 30 years from now. So these improvements to the CPI are said to give a more accurate measure of consumer prices. However, these changes could also be a convenient way to include or exclude certain products, to skew results, etc. So here was a noteworthy sentence. In other words, the CPI doesn't measure changes in consumer prices. Rather, it measures the cost of living. I wasn't satisfied with 2. I made it a trifecta of inflation and cost of living oriented articles. The third one, which was released on December 15th, 2021. It was entitled, "Inflation may be much higher than reported, and that could hurt seniors and the poor." Obviously, that echoes what was noted in the previous article. And this is by Mark E. Fitch. And so it mentioned that in that time frame, which was December 2021, before the Fed changed its policy to begin to fight inflation, he noted that they announced inflation in 2021 had hit 6.8%, a rate not seen since 1982. But according to some economists, the reality may be much worse, and that could leave senior citizens and others who rely on Social Security benefits in a tough spot. So this is a very specific quantitative assertion about the measure of CPI. Chief economist for Data Corp Partners, LLC, Donald Klepper Smith, noted, back in 1980, your CPI was 13.5% and had we been using the algorithm from 1980, we'd be looking at 14.5% today. So he's saying that the 6.8% in December of 2021, or reported in December of 2021, is the equivalent of 14.5%. So the individual went on to note that though it was not necessarily a perfect measure at that time, it is still maybe even less perfect now. Something that is currently in our CPI measure, something that they have recently begun doing is what's called the owner's equivalent rent. And everyone knows that owns a home knows that the insurance, property taxes have gone up, and of course, because of the rise in interest rates, the cost of financing has gone up. So what they've done is, rather than allow the cost of ownership to dominate the inflation numbers, they've created a way to balance that out more. So it suppresses that impact. Because it is considered transitory. So the individual noted that change alone, changing to owner's equivalent rent, knocked 1.5 percentage points off of the CPI measure alone. So last thing on the agenda is the premiere of the Everything is Fine segment. The Everything is Fine segment is really just a sarcastic look at what is being sold to us through the media or stated by policymakers, which is obviously false or incomplete, and leads us all to believe that things are better than they really are. So today's Everything is Fine news story, I went and did a search specifically about banks and what we're dealing with right now. And so I found this article called Small Banks Big Reach, being posted by the Financial Times just a couple of days ago. And its subtitle, Are the Banks on the Edge of Another 2008 Style Precipice? And as I went through, I found a number of interesting things. So there's a specific thing I wanted to note that's in here that is a forecast tool. So the Everything is Fine segment is liquidity crisis becoming a credit crisis. Yes, I said that correctly. And this article happens to address what they mean by that. Let me read the quote straight from the article. It says here, we expect a liquidity crisis, which is the recent bank failures, will soon pass, but the events of the past 2 weeks suggest that a credit crisis will soon be upon us. This is not going to be the sort of Wall Street credit crisis that we have seen in the past with waves of corporate defaults and IG downgrades. Instead, this looks more like a Main Street credit crisis where small businesses will soon find their access to credit restrained. The regional banks that have fueled the small business boom that has been ongoing since the pandemic will be far more limited in their ability and willingness to lend, irrespective of their deposit stability or access to liquidity from the Fed. So what that is saying is that foreseeable impacts of this is a restriction of the lending to small businesses. So their credit lines may be curtailed or will not be extended where they would have been before. So small businesses that require short-term funding to make payroll, to do other things, instead of using their cash for investment, they will have to use that to cover their ongoing expenses because they don't have access to the credit they once did. They will not be able to expand. They will curtail hiring because they know that they need to be able to essentially hoard their cash to buttress against challenges going forward because they won't have access to credit should they need that as a backstop. So clearly a good forecasting tool. And again, here at Atocha Global Analytics, that's what we're about. We're about being able to forecast what is happening by looking at these different metrics, these different indicators. And looking at this particular indicator, we can say, okay, small business shrinking, and we will likely see a lot of business activity slow down. This will impact the purchases of vehicles for fleets. This will limit investment, all forms of capital investment for businesses at various levels. If small business owners are curtailing their spending, that means less pizza parties in the office. That means that they're not taking their families out to eat as much because they are keeping more money in the business rather than funneling that income into their households. The issue isn't just a matter of whether or not the economy is moving at a good pace. It is about the banking system increasing the the cost of lending, but also radically shifting the value of assets in many cases. In many cases, these assets are decreasing in value as much as 20%. Though this article does mention about certain types of bonds, they did make note of some things that I wanted to highlight that I've already been talking about for some time. So, for the next year at least, banks can respond to deposit runs, their bonds, without crystallizing steep losses, which is mark-to-market losses. And again, whether that's bonds or whether that's forms of real estate, these assets have shifted significantly because of the increase in interest rates. All right, so a couple other things that are noted in here. Goldman Sachs, because of these factors, they cut their their Q4 GDP forecast from 1.5 to 1.2%. Seems like a small change, but it is only the first of what is likely going to be several revisions. Now we get to what I was focused on, which is banks with less than $250 billion in assets make up about 80% of commercial real estate loans. According to economists at Goldman Sachs, along with 60% of residential real estate loans and half of commercial and industrial loans. So there's a significant amount of loans that are directly impacted in these smaller banks by the changes that were precipitated by the Fed's sharp increase in interest rates. Here's something else I've been talking about. Bank analysts already expected office building valuations to decline by 30% over the next few years, according to a late February note, along with 20% declines in multifamily housing and 10% in retail. I recently did a search to see what the occupancy rate, and I want to note occupancy versus vacancy. They are a mirror image of each other. So if you have 80% occupancy, you have 20% vacancy. So literally I have a measure from a source that specifically tracks what the occupancy is for office nationwide. And in the last few weeks, it had been averaging 50.1%. We had a shift this week. It went to a 47.1% occupancy, which is a 53% vacancy. That it probably is something where it is not updated on a daily basis or even necessarily on a weekly basis, and it takes time for the survey to come back and that sort of thing. So it may not be just that there's this drastic change over the last week, though it quite possible there has been some noteworthy change with some of the stresses in the financial system. However, if office vacancy is increasing more and continues to increase, you're going to see significant pressure there. They note that the multifamily valuations are expected to decline to 20%. That is very reasonable. Now, retail, I did research as far as what the retail occupancy rate was as well, and it was well over 90%. So therefore, retail is fairly strong for occupancy. Multifamily, it's expected to decline. Though occupancy is very high right now, there's a tremendous avalanche of supply that I noted earlier in this video. So these factors are all going to hit small and regional banks quite a bit harder than you might anticipate. I would qualify that multifamily specifically, they oftentimes use a form of agency financing through Freddie Mac. And so it's a little bit different structure. Yes, it does impact banks, unlike many of your mortgage-backed security bundled loans. It can absolutely impact the local and more regional sized banks a bit more than other types. But in a severely adverse scenario, in the Fed's latest round of stress tests, large regional banks had the most overall downside potential from commercial real estate, Barclays found. So clearly this is something that is a cause for concern. And they aren't mincing words within this article about this being of concern. Yet the Federal Reserve continues to have a policy that is trying to fight inflation that they've caused through raising interest rates, which will further devalue assets, whether it's bonds or real estate, further devalue assets, and therefore creating a longer, more profound cycle of correction in order to reset these different markets. So here's the last forecasting tool of this video. So for tracking the outlook of individual banks' deposits, credit sites, which is one word, credit sites, SIGHTS, suggests following an unusual leading indicator, which is rating agencies' actions. Now, rating agencies obviously dropped the ball on a lot of the collateralized debt obligations and mortgage-backed securities during the financial downturn of the Great Recession. However, they have, because of the criticism they've received, they have really revised their methodologies, and they are much more effective. And reason noted within the article why you would want to look at that is they often get to see data that the general public doesn't get to see, or gets to see it much sooner than the general public would be able to get to see it. So in closing today, a huge video that I'm probably going to have to split into 2 or 3. I think that there are some significant things that are on the horizon that we need to be watching for. The banking sector, of course, continues to be under stress. You know that I want to go back and I want to note something that I had said in a previous video and apply it to everything that was discussed today. I had noted what are markets, and markets are really a brain trust. It is a collective brain trust, a collective opinion about upcoming events or the current state of affairs. In this case, of course, is financial markets or real estate markets or commodity markets. These are reflections of the status quo and the foreseeable future with those things. They are a collective opinion. It is fallible, but it is a collective opinion. The caveat to the markets being a collective opinion, you can't look at stock markets necessarily as a matter of it is a collective opinion of the overall economy alone, because that is not necessarily true. It is what is beneficial for stocks in this economy. So what drives prices of stocks? What drives values attributed to these different companies is not always the same thing that you would think applies to Main Street. In many cases, the stock market is looking at, they expect the Federal Reserve to reverse course, which is commonly termed as pivot, to pivot and reverse course and lower interest rates and to return to a more expansionary monetary policy. That monetary policy would increase values of stocks. A lot of money flowed into the stock market during the Great Recession as a result, and it created a distortion in the stock market that is not necessarily reflected on Main Street. And the current consensus is that the Federal Reserve will reverse course. So in conclusion, obviously the real estate markets have been dramatically impacted, but the real impact has not really been revealed yet. I'm all over the news right now is the most recent release of the latest home price year over year released by the National Association of Realtors. Clearly, year over year is a snapshot against a snapshot, and this is the first time since 2012 that there's been any noted decline in the statistics. However, if you go back in time, you can see that from really May or June, depending on the locale, most areas began to decline, and it took a while to erode the preceding increases that were reflected in the stat. We finally reached that inflection point where now we are on the downslope, where we are seeing the full magnitude of the declines being reflected. You wait until May or June, it's going to be then showing a full year of declines. So these declines, as reported month to month, on an annual basis like this, it's going to amplify over the next few months, and so you're going to see it more and more in the news. And in regards to actually the South Florida market in particular, the full impact of increased taxes, property taxes, because of the increased values, have not really been impacting insurance costs. We have not seen the full impact of last year's hurricane being factored into the increased premiums yet. All these factors are going to erode the market. Finally, for tomorrow, I'm going to be covering, of course, the Fed has their meeting tomorrow. Going to be covering a couple more Fed-related things. May touch on some housing. I'm going to have the questionable truths of the day from the sheet files, plus another segment of Everything is Fine. So thank you for watching today. See you next time. Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.